Australia's housing market's made further progress, with the housing market recovery in our two biggest cities, Melbourne and Sydney, gaining pace, property prices increasing again, now 5 months in a row. But house buyers are back, first home buyers are back getting a foot on the property ladder, and investors are slowly returning. And as in previous months, they've been buoyed by falling interest rates, the prospect of another rate cut even next year, and less stringent lending criteria at a time when our media has been more positive about property as well. As a result, auction clearance rates are up, asking prices are up, property values are increasing in some locations and not in others. And if you've been reading the media, you've been seeing that some property commentators are even forecasting double-digit capital growth next year. However, our property markets are very fragmented. Not all markets are performing the same. So to explain what's really happening in the market on the ground and to give his forecasts of what's ahead, let's chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
Good morning, Michael. How are you?
Good. Well, another month's gone since our regular monthly update, and it's much the same in the big world economy. But recently, the International Monetary Fund has reduced its global growth forecasts for 2019 from 3.2% to 3%. And it's suggesting we're having a synchronised global economic slowdown. But it's a slowdown. It's not a recession. And still overseas, the US-China trade tensions and the uncertainty about Brexit take their toll, and they're contributing to a weakness in trade and production. Back in Australia, we've had another interesting month in our economy. The International Monetary Fund has warned that our economy is going to grow probably a bit slower than what the Reserve Bank is hoping. And despite 3 interest rate cuts and some tax relief, the Reserve Bank's monetary policy just doesn't seem to have stimulated growth or spending like they'd hoped. Rather than engaging shoppers, it seems the rate cuts have actually hurt consumer confidence, as Australians are worried about what's going on in the economy, the implications that this low interest rate economy's got for us. But there are obviously some positive effects. Australians are paying down their debt faster, but they're spending less. So what does this mean, Andrew? Should the RBA put a pause on rate cuts since there's no hard evidence of their efficacy?
Well, there's some important data that will determine, I guess, the position for the rest of this year, Michael, in terms of the RBA's rate settings. And firstly, with the prospects of another cut to the US rate and also inflation data out for the September quarter. So where those figures or those outcomes fall may influence the Reserve Bank, but I'd suggest that they will wait till next year. Nothing's really happened in terms of the macro economy from the 3 rate cuts that we've had. I think 3 cuts in a short period of time is enough, but going forward, I think we'll get another cut next year at some stage. I think the forecasts for a global slowdown, I think the jury's still out on that. Getting some more positive data on the prospects for the world economy now, and a lot of this is sentiment driven. The IMF tends to be behind the game. They rely on data that comes out of national governments for their forecasts, so they always tend to be a little bit behind in what they predict, but perhaps oversold the downturn doom and gloom a little bit too much, but we'll see what pans out.
Looking at our property markets in Australia, auction clearance rates tend to point to a strong market. Now, we had some high auction clearance rates a while ago, heading up to the 80s, and they've dropped down to the 70s. And some of the property pessimists are saying, told you so, it's a dead cat bounce. But that doesn't seem to be what we're seeing on the ground. There's a lot of energy in the market.
Absolutely, Michael. And clearance rates are still close to 80% in Sydney and Melbourne on weekends. And we're starting to see more sellers coming into the market as well, which is no surprise. Significant competition for most properties on a Saturday in Melbourne and Sydney. Also seeing that energy translated back to the smaller capital city markets as well. But we are starting to see sellers getting more interested in putting their properties on the market. Of course, that's because prices are rising with that rush to market, I guess, to get a sale before the end of the year. That we've seen some very big numbers towards the end of October, particularly in the Melbourne market, which were encouraging in terms of confidence returning to vendor. If we look at Melbourne and Sydney and differentiate them, Melbourne just has tended to ease over October. Its clearance rates have moved into the mid to higher 70s, whereas Sydney has remained close to that 80% clearance rate mark. But both markets are very good markets for sellers, and prices are clearly still rising.
Well, when you look at the graphs that are on the screen at the moment, we've just shown Sydney, we've shown the trends in Melbourne as well. Yes, even they've dropped a little bit, they can't keep going up and up. You can't keep having auction clearance rates above the 80% mark. There will always be some vendors with unrealistic expectations who ask too much for their property, so they're going to pass in. There'll always be some properties that aren't as saleable. So to get figures in the sort of levels that you've shown in your graphs at the moment are still very, very strong markets. Let's compare them to a couple of years ago. When we're looking at the Sydney auction clearance rates, you're showing that it's around 79% today. It was quite a few years since it's been at those levels, Andrew.
Yeah, 2016-17 was the peak of the market, 2000, when we did see very strong prices growth in Melbourne and Sydney. That 80% tends to be the benchmark of the peak of the market, but 80% will always result in significant prices growth. We're seeing quarterly prices growth around about the 3 to 4% mark in both Melbourne and Sydney. That is very strong. Of course, that's over 10% per annum. If we annualise that, you've got to understand that even though prices are rising very strongly in Melbourne and Sydney at the moment, Michael, and at that 10% plus per annum rate, prices still remain 4, 5, 6% below where they were 2 years ago. So buyers are notionally buying at a discount. And that's why, of course, they're enthusiastic in terms of where prices have been. And that, of course, is another reason why sellers are a little bit hesitant to be back in the market, because a sale for them now in current market conditions would still be below what they could have got 2 years ago. Now, as we get closer to that peak point, we'll see more sellers coming into the market. But you've got to understand that with around about perhaps 6% left of growth to get back to previous peak levels, we should get that at current rates of growth, perhaps the middle of next year, all things being equal. But by that stage, the interest rate cycle, I believe, would have flattened out. So therefore, there'll be no real capacity to push prices up based on lower interest rates. And with incomes growth still flat, I think once we get back to those peak levels sometime next year, later next year, we'll see a much flatter housing cycle going forward, because we won't have the drive from lower interest rates or higher incomes to push up prices at the rate we're pushing them up now. And a lot of that is being driven by catch-up energy from buyers that are, in a sense, bargain hunting.
Sure. At the lower end of the market, though, first home buyers have been coming back, and they're going to come back maybe even a little bit more with a new scheme coming in next year. You also measure asking prices. So while, as you've said, median prices have moved up, asking prices is just another way of looking at what's happening in the market. Your chart here gives an indication of what's going on, Andrew.
Asking prices, of course, reflect activity in the market in real time. And they do reflect, of course, the views of sellers and agents who are providing them with price estimates based on current market conditions. So they tend to be quite robust. They're not backward looking, which house prices tend to be, of course, because they reflect what's happened in the market at a previous period. But those asking prices certainly validate the sale price data coming through. Asking prices continue to rise and consolidate. Sydney was flat over October, but of course it's had some growth over previous months, so it's consolidated. Melbourne continues to rise. Another capital city markets, with the exception of Darwin, all recorded increases in median house prices over the month.
Well, of course, the markets are fragmented, as we said before, so there are different price points, there are different types of accommodation, houses, apartments. There are the inner, more affluent areas, which are currently where price growth is occurring, particularly in Melbourne and Sydney. But remember, they're the locations where the prices fell the most as well. And the outer areas, the outer suburbs, the lower socioeconomic, more blue-collar areas aren't doing as well. They may get a bit of a pickup next year, Andrew, if first home buyers are coming back.
Well, that's right, Michael, and that'll be certainly elevated by the first home buyer deposit scheme, which comes into force in the 1st of January. But we're also seeing some interesting results in Melbourne and Sydney. We've seen the Hills, the northwest of Sydney, quite a strong market, and Canterbury, Bankstown. They're mid-price range markets, Michael. And the top performer in Melbourne has actually been the outer east, which has been a boom market now for most of the year. But as you said correctly, outer suburban, lower price regions still not picking up at the same level as, and that's, of course, the southeast in Melbourne, the outer west, and in Sydney, the outer west and the outer southwest.
Now, those interested in property investment clearly want their properties to go up in value, but they're also interested in what's happening on the rental side of things, vacancy rates and asking rents. Our rental markets have been reasonably flat most of this year, Andrew?
Well, look, we've had some differential movement in rental markets over October, Michael. I think it's interesting that we've seen vacancy rates rising in Sydney for units, and correlating with that, we've seen actually Sydney unit rents falling below $500 a week for the first time in a few years. Still downward pressure on rents in Sydney. House rents remain stable, but vacancy rates still rising for units in Sydney, Michael. And so I suppose that is no surprise. And we still have a lot of stock in the market. And one of the factors that's driving the rental market easing in Sydney is an easing in migration particularly. And the other point is that we've got a lot of first home buyers coming into the Sydney market, and that's taking demand away from rental properties. So we've actually seen some increases in vacancy rates also in Melbourne. Most other markets were the same in terms of vacancy rate. But overall, look, most of our housing markets are undersupplied for rental properties. Vacancy rates are low.
2 months to go till the end of the year, actually 2 months to go to the end of the decade. It's very likely our property markets are going to remain robust for the next couple of months. Buyers are going to keep looking to get in as the property prices rise. Sellers are going to get back into the markets again. And I see next year we're going to still have price growth, but I agree with you that it can't keep going at the double-digit annual rates that we've been getting in the last little while. However, interest rates probably are going to fall again. There is, in the short term, going to be a undersupply of property as new properties are not coming onto the market at the rate they were before. So if we look forward in a year, what are we going to be talking about this time next year, Andrew?
Well, the doomsayers will be struggling because we'll be moving into a flatter cycle, I believe, and the boomsayers will be struggling as well. So I don't know where the media are going to go for an exciting property market headline. Even if we get a cut in rates, the banks are now constrained from passing on these cuts because of this is really narrowing their margins. And I think that we'll start to see a whole new cohort of investors looking at property, given the consistency of yields and also the potential for continuing capital growth. I still believe we're going to see capital growth, Michael, and that's the nature of our undersupplied market, but it won't be double-figure growth. It'll be going forward 2, 3, 4, maybe 5%, depending on local factors. You've got to understand prices growth now is not being driven by some sort of mysterious bubble inflating energy. It's all about catch up in Melbourne and Sydney from where they were still below 2 years ago. And that's why we're not seeing prices growth at anywhere near the same level in other capital city markets, Michael, because there it's still around about their peak price levels. And that really does validate that whole position of Melbourne and Sydney just catching up to where it was. And then from then on, because we won't see cut in interest rates when that occurs, I believe, going forward to drive the market, it'll be a much flatter price cycle going forward. And I believe, even though I don't like forecasting a long way out because it's too difficult, I think that we will see a lengthy period of modest prices growth driven by low incomes growth and a very low, non-existent, perhaps, interest rate environment.
Sure. So the world will be very different moving forward, but our strong population growth, our economy, yes, which is still chugging along better than many other countries, we're still envy of a lot of other countries. And the shortage of housing is going to underpin our property markets. So we'll be getting together once a week in these regular Property Insider chats. And once a month, we'll do these market updates to keep everyone informed. Thanks for all the hard work putting those charts together. Catch up with you soon, Andrew.
Thanks a lot, Michael.